Good morning, everyone. Thank you very much for joining our first webinar, which is related to FX hedging and some FX mis-selling as well. So just to begin at the outset, I'm expecting this session to last no more than sort of 90 minutes. I know we're all very busy, and there will be time for questions and some potential discussion at the end. Please, feel free to send your questions through via the sort of chat system, but I'll take them all at the end. In terms of who we have on today, we've actually got quite a wide range and mix of people. So we've got some barristers, some junior counsel, some QCs, we've got some solicitors, we've got some accountants, we've got actual clients of ours who are importers, exporters, we've got some property clients, and I think we have some prospective sort of currency hedging clients as well. So a very wide range and mix of people there. In fact, I think we've got a couple of competitor firms as well, but that's fine because the more information that gets out there, the better. It's all about transparency. So just to sort of kick off in terms of, and so some of you, of course, will know some of our background, but there are some new people on the webinar, so forgive me if I just cover a little bit of old ground and just give a bit of our background. So our name itself means, it's actually a Hindu Sanskrit name, which means sort of ultimate truth and knowledge, because what I call philosophy is about is actually just trying to bring transparency to the world of derivatives. A lot of people think derivatives are complex and like Warren Buffett describes them as weapons of mass destruction, but we think derivatives can indeed be very dangerous, but they're very useful risk management tools if used properly and well understood. So we think they've got a bit of a bad rep, but it's just about using them properly. So our job is just to try and make people understand them a little bit better. So how did we come about? Well, sort of my background is that I've studied economics, worked at the Treasury, and then worked at Lloyds Bank. And there, started dealing with some sort of mid-cap, large corporate clients. And I was quite surprised of the number of corporate clients who just didn't understand that they should be seeking independent advice on certain transactions such as derivative transactions. It's unthinkable that a corporate client wouldn't take legal advice when signing certain legal charges, and they wouldn't have an accountant for parts of their business or a finance director. But when it comes to hedging, they just simply trust their bank, who are the same bank or broker who's actually providing them the contract. So and how I actually first set up Vedanta Hedging was there's an uncle of mine who he's he's worth at least sort of £400–500 million. In fact, he's worth more than the Queen. And he actually didn't understand hedging at all, and he said to me, RBS want me to do a hedge fund. Can you help me with that? And that's when I thought, well, hold on a second. You actually mean hedging here, but if someone is that wealthy just didn't understand anything to do with derivatives, then there's going to be a lot of businesses out there who just need some assistance in this area. So that's how we set up. And in 2011 and or 2010 and 2011, we found there just wasn't anybody providing this kind of independent advice to what I kind of call mid-cap corporates. So owner-manager businesses, not necessarily listed, but ones who have got anything turnover up to even a couple of £100 million, who just don't quite understand derivatives, or at least don't have access to that independent advice or pricing. So where are we today? We've got a very well experienced team with more than 120–130 years of combined derivative experience, all from the major and global investment banks. Crucially, we're authorized to be able to give advice to all types of customer, right down to very small, what the FCA calls retail clients. And in fact, we've actually advised the FCA before on a couple of matters, including and also the government as well. And interestingly, the government's actually published our advice on how hedging should be provided to SMEs. And we'll discuss some of this later, but it's not rocket science stuff in terms of, SMEs shouldn't typically be selling options. They shouldn't be entering into contracts which are too long or too large for their exposures, etc., etc. And interestingly, just on the FCA, and again, we might touch on this a little bit later, but we have also discussed with the FCA this issue of currency derivative mis-selling. But let's just say I wouldn't be holding my breath waiting for any particular movement out of the FCA on this, given how backlogged they are with the whole political environment as well. And we've been fortunate enough to help a lot of news organisations and people understand some of these issues. So on to sort of looking at why does someone need an independent advisor. The kind of key sort of areas that we sort of tend to focus on as a business are around looking at, we kind of call it the kind of whole circle of sort of advisory type work, which relates to actually helping businesses understand their underlying debt, so around debt advisory. What we're going to be talking about today, which is around foreign exchange hedging, dispute resolution, because it's our sort of day job of making sure that corporates understand the hedging products that they're getting. That allows us to then go back in time and say, well, actually, what should have been provided or discussed or illustrated in 2007 or 8 or last year or whatever it may have been. We will look at sort of the hedge accounting implications. These are accounting implications that have come to the forefront over the last year or two especially, and now businesses are actually seeing volatility of derivatives actually hitting their income statements and their P&L statements. So suddenly now, we're getting businesses saying to us, what's this huge charge I'm having to take, in my P&L? So again, there's some work that we can do around, looking at mitigating some of those impacts, although it's quite a complex area. Documentation is an interesting area. Regulatory documentation wasn't something that was ever given much thought, but in fact we're just doing some advisory work for a client right now, and the bank is requiring them to sign 7 different pieces of pure derivative regulatory documentation. And especially with all the lawyers on the line, you wouldn't expect me to say anything other than you've got to sign, you read all these documents very, very carefully, because they can and will have implications for these businesses. Otherwise, to be blunt, the bank wouldn't be asking you to sign these things if it didn't mean anything. So talking a bit more specifically about FX and sort of currency hedging advisory, what are the kind of core things that we do? Well, we begin by looking at the various different currency exposures that a business actually has. Now, yes, with some businesses it's pretty straightforward. They're maybe just buying some widgets in from China, which means they're just simply buying dollars. And then they just need to convert, they just basically just be buying dollars and selling sterling accordingly. But there are some businesses, and we'll look at one example shortly, where clients can actually have many different currencies, and it becomes quite complex as soon as you've got more than a couple of currencies there. We will then work with the business to try and formulate what's called a budget rate. Now, a lot of businesses, some of the first things we ask them are, well, what exactly is your budget rate? And they sometimes look a bit puzzled. But this is something important, because one needs to, currencies as well as you all know are very volatile, and one needs to actually think about, from a business perspective, at what rate do I need to be able to buy my dollars or sell my sterling, whatever it may be, in order to be able to meet my business plan, whether it's for the next year or next 5 years. Especially when we've got very competitive margins, particularly in retail, when margins are so tight and competitive, one needs to be able to understand, this is my buying price, this is my selling price, there isn't much leeway I've got in between there, so I need to be able to lock in a certain profit margin. Well, if you're doing that, you need to make sure that your key purchase cost is locked down as well. So we help customers to actually try and formulate this as well. And then what we do is we look at various different derivatives or simple hedging contracts, such as spot contracts, forward contracts, that might be appropriate to meet the strategy. Some of you may find it so odd saying, why are we recommending FX derivatives? So again, to make this very clear, we are not anti-derivatives at all. And in some cases, we would even suggest to clients that they do look at, in certain cases, rather complex derivatives. But again, it has to be done in a very careful, considered manner, whereby you're looking at it for a certain period of time, for maybe a small part of your exposure, and that you understand very clearly the very detailed risk-reward characteristics and benefits of doing so. And then we'll actually look at sort of what we call the kind of benchmarking of this, because it's all very well saying this is the appropriate currency hedging contract for you, or this is what you should be doing. You should be buying 50% of your euros at spot or forward contract. But then there's the other element, which is the fact that these prices are very, very opaque. So obviously FX derivatives are, by their very definition, opaque, because there is nowhere online that a business can just go on there and have a look at what the pricing of an FX option contract, even a simple one, should actually cost, because there's many variables that go into it. We've got the same specialist pricing software that the banks do. In fact, we use the two leading software providers, which provide real-time pricing, so that we can actually be on the same phone call when these contracts are agreed, to make sure that even tiny movements that are going on are not used by the bank or the broker to adversely affect the price the client gets. And although the client's often not paying money for this, this can actually result in thousands, if tens of thousands of pounds of extra cost, which they don't necessarily understand. Just a quick example on this. We're advising an interest rate client at the moment, and he was sort of saying to us, well, actually, I'm not sure if I'm not really too worried about the prices moving at the moment. So we looked at his contract and we said, well, actually, given you're looking at the 10-year swap rate, you're looking at hedging this amount of debt, each basis point move is nearly £40,000 of cost implication for you, although you're not paying for it. And he said, well, that's okay. I can't see these things moving too much. The Brexit votes happen, etc., etc. Well, I said, well, okay, that's fine. But just yesterday, on the day we actually priced it for him, we said that the 10-year swap rate had moved 9 basis points. So if you got on the wrong side of that move, you're potentially talking about an extra cost to the business of more than £300,000 potentially. So even though customers are often not paying for some of these products, it doesn't mean that they don't need to have these things price checked because of the value that's built into them. And then we'll also look at the sort of hedge accounting implications where appropriate. Again, this is quite a complex area, and you do also need to take some specialist tax and potentially accounting advice as well. But certain structures will lend themselves to being more favorable for hedge effectiveness than others will. And then finally, and I do actually put this point finally, we actually talk to the client about market views analysis. Now this is interesting because a lot of clients, the first thing they say to us, look, where do you think the dollar is going? Where do you think the euro is going? And whilst there are lots of banks and brokers and independent firms out there who will just keep talking about different views on market rates, our view is quite clear on this. In the short term, certainly, and even short to medium term to an extent, one cannot predict with any real certainty how any of these market indices are going to move, whether it's interest rates, whether it's inflation. Okay, I mean, look at our Bank of England governor, Mark Carney himself, isn't particularly good at predicting inflation, and that's kind of his day job. You simply cannot predict where currencies or interest rates are going to move in the short or medium term. We can happily provide rationale and explanation about why certain things are happening. But there's a reason why perhaps economics is called the dismal science, and it's just very, very difficult to predict things going forward. So we'll give clients a view about what we think is actually happening, but we certainly don't think that's the most important thing. The most important thing is to look at what is important for your business, what does the business need to achieve, what rate do they need to buy and sell their currency at, and then you look at what's available in the market. Rather than, unfortunately, we come across too many businesses who get carried away, almost treat this as a bit of kind of gambling or a bit of fun, and they think that, they're sitting there watching. I know it says CFAX there. They're sitting there watching, the Google, on Google or BBC News what the currency rates are, and they all think they know what's going to happen. But that could be quite dangerous. So just talking about one of our clients, a case study for Camden Market, which is actually a listed business now, Market Tech Holdings. So Market Tech Holdings is worth nearly £1 billion today, and they're a listed PLC. Now, they're one of our sort of long-standing clients that we give hedging advice to. But interestingly, after they became after sort of they got effectively bought out by Teddy Sagi and became more of a sort of tech-faced company as well, they said to us, look, we just need some help understanding some of our currency exposures because we're used to just managing our real estate in property in Camden Market. And they've got various significant sized tech businesses. So in fact, we went to, one of my colleagues, Mayad, and I, we went to Berlin to meet one of their subsidiaries who themselves had quite a few different FX issues because they had, being a tech company, and then they had $100 million turnover. They were selling, most of their clients were American-based tech companies, so they were getting receipts in dollars. They were based in Berlin, so obviously they've got to pay their rent and their staff all in euros. And of course, being part of Market Tech Holdings, which is sort of registered in the UK, they've got to report everything back in sterling. So there's quite a few different issues here that we had to look at. So we had to, so there was things at the board level which we had to try and implement in terms of how does the group as a whole manage its currency risk? What kind of policy should it have in place for managing its currency risk? Right down to the operational level, where the different subsidiaries, like the chaps in Berlin, how are they physically buying and selling their currency on a week-to-week basis? How are they checking the prices of it? What structure is right for them? One of the structures that might be right for the company in Berlin may not be right for the company, one of the company that's based in the UK. So, there's quite a few different areas of complexity there, but they were, very happy with the policy that we came up with. But again, it's not just a static policy; it's something which has to be reviewed because the currency markets are always moving, and one needs to be able to tactically respond and have enough flexibility to allow yourselves to adjust. So they were very happy with the advice that we gave them anyway. A testimonial there, but I thought of some of the work that we've done with them in the past. Another example of a client that we sort of gave some currency hedging advice to, much kind of opposite end of the spectrum now, much smaller business who was somewhere in the Midlands, who effectively just had to buy a certain amount of dollars worth every year for their electrical components, which obviously sourced from the Far East. But the interesting thing is that they sort of said to us, look, we're actually seeing quite a lot of volatility in our movements, and although the absolute numbers are quite small, these purchases are, almost 60% of our sort of cost base. So we kind of, we did start, the company said to us, they did start to look at setting a budget rate and thinking about what they wanted to do, but actually they kept then breaching their budget rate, which is obviously an issue. So they said, can you try and help us? So we looked at that, and what we tried to do was, what we did do is we said some of the FX derivatives they were going into were just too expensive, and a couple of them were too complex. So we sort of help in a pricing perspective. We made sure that the structures they were entering into were a lot cheaper. And even just by doing simpler structures and making sure there was some more transparency there, we ended up saving them, in some cases 10, 12, 15% of some of the contracts they entered into, which may not seem like a lot, but for this customer, this was 60% of their cost base. And it's one extra cost that they don't need to worry about. And again, it frees them up to manage their business, which is ultimately what these business owners should be then doing. So, I guess the broad part of all the stuff that we're sort of saying here is there is what we see here, a real asymmetry of information. I still find it quite shocking how, this is what drives us, I guess, to be passionate about what we do, because we still see so much imbalance of information, particularly within the kind of derivative world. It's interesting, I was discussing with a barrister last week. He said, look, if I'm going to buy a car, and this is where we're talking about sort of things like information duties and duty to disclose things, etc., and he's like, the car salesman doesn't necessarily have to disclose whether the car was involved in an accident before, or whether there's some issues with it that he doesn't know about, or bits and pieces, etc. And I said, well, look, that's kind of potentially fine if one is looking at purchasing a car. Most people will generally understand if you're going to a car dealership and you're buying something from a second-hand car salesman, you need to have your wits about you, which is fine. And you may understand, look, you're buying a car for £10,000, but actually it may only be worth half of that money. But when you're entering into derivative contracts, certainly small businesses and even mid-cap businesses aren't going to have come across these kind of derivative concepts before. These concepts of margin calls, mark-to-markets, unlimited breakage costs, and this is why I think these situations are quite different. For example, if you're entering into a contract, again, I'll give you an interest rate example. If you're entering into a £10 million loan and a £10 million swap, yes, you may well understand that breakage costs may be significant, and if interest rates go down, you might have to pay some breakage costs in them. But a lot of businesses won't necessarily understand that at the very outset, the bank knew that the breakage cost could be as big as 30 to 40% of your loan amount. And I can tell you, most business owners, if they think that there's going to be a £3 or £4 million breakage cost on a £10 million fixed rate loan, they're certainly going to think twice about going into one. So again, this is all just about asymmetry of information. Where it comes up in the FX market, and again, some of these things that we'll talk about briefly, is how FX brokers are often routinely, and banks, showing very, very attractive, juicy carrots to customers by saying, hey, look, you can get 4, 5, 6 big cents, or big figures as it's known in the industry, off the current forward rate or the current spot rate. Now, if a business owner is told, would you like to buy dollars at a cheaper rate? What business owner is going to say no to that, right? Just like, no one's going to want to voluntarily pay more money. But at the same time, if they, the small business owner may not understand that, yes, he's getting 5 big cents off the spot rate today, but actually that broker is embedding circa £1.2 million cost in these contracts for the next 6 months. Now, that's not about market movements. That's something which is known on that day upfront to that broker. Now, again, there's nothing wrong with that contract necessarily, but again, the customer needs to be able to understand, right, I'm getting this benefit, which I can see, I can enjoy, and I'm looking forward to this dangling carrot in front of me, but then do I understand the quid pro quo? And if they understand the quid pro quo and they want to take a view on what may or may not happen to the currency going forward, that's absolutely fine. That's their business decision to make, and that's what they do every day of their lives. They make business decisions. But you've got to have that fairness of information in our view. So again, we liken this to sort of just trying to sort of shine a light into a sort of black box, as it were, because unfortunately, some of these banks and brokers do make these currency derivatives just look like black boxes. So talking now a little bit about some of the things that we've seen in the past, and some of the sort of kind of dispute or mis-selling areas, I guess. One of the things which has certainly brought this to the forefront is what's happened with the Brexit referendum vote. Just like with interest rates, a lot of businesses may well have been mis-sold in 2005, 6, 7, 8, etc., but may not have perhaps realized some of the impacts of it, of course, until interest rates actually began to sharply fall. In the same way, we've been coming across a number of these businesses for more than the last couple of years, but it's really come to, I think, the forefront, since we've had the Brexit vote, because of the incredible volatility that we've seen, particularly related to sterling-related currencies. I mean, you're looking at the pound against the dollar there. You're looking at nearly 25% move just over the last couple of years. Now, again, whatever side you're on, that can either be a very, very good thing for you or a very bad thing for you, but it's a lot of volatility to have in there. And if it's an advantageous move for you, great, because you want to try and lock that in as much as you can. But if it's a disadvantageous move for you, then one has to think, in this day and age, or any day and age, how many businesses can handle a 25% hit to one of their cost items on their P&L. And same with euro as well. Euro is a little bit more interesting because one can argue about the health of the eurozone itself, but certainly sterling euro will affect a number of our clients, and there's a lot of volatility there as well over just the last couple of years. And it's interesting we talk about this time frame, a couple of years, because that might seem 2 years is actually quite a long time in the FX markets, and one of the things that I'll talk about later is, unfortunately, we've seen some of these FX contracts lasting up to 2 years or more, which I think is generally quite inappropriate. So in terms of just our track record and some of the work that we've done in sort of dispute resolution, because we've been doing this for nearly 5 years, predominantly we've done this a lot of this on the sort of the interest rate and sort of borrowing side. And we effectively will just review sales correspondence, the sales process. We'll look at the pricing of the products or the alternatives that should have been provided. We'll look at the sort of risk modeling, the contingent liabilities that, again, banks or brokers would have known at the time and indeed marked against some of these clients' assets at the time. And then our job is really just to provide this technical analysis and regulatory analysis to some of the people on this webinar. So some of the solicitors, the barristers, and of course to help clients understand themselves how and why some of this stuff should have happened more appropriately in the past. And we've been fortunate enough to be able to help some of the largest property companies in the country. We've got some large sort of importers and exporters who we assist, who again just don't have the transparency and understanding to understand this. I think we probably help not far from nearly 800 to 900 businesses over the last 4 or 5 years. A number of them, of course, have been through the IRHP review, which we helped instigate nearly 5 years ago. But nonetheless, there's a lot of businesses that we've helped them. And again, it ranges right from businesses who've got a turnover of £1 or £2 million right up to institutions which are listed on the stock market. So turning now a little bit to some of the actual derivatives that one comes across in the sort of foreign exchange world. These are some of the sort of names which certainly if any of you have seen some of these products or some of these disputes, these are the kind of product names that you may come across. And in fact, I'm going to show you a couple of examples of a couple of product profiles shortly. There are quite a few unique things that one needs to look at when we're assessing FX derivative mis-selling, which I'll briefly just sort of cover through now. So some of the things which are, I think, quite unique to the FX world There is, advice is a very important word, as a lot of the solicitors and barristers on the call understand. Legally, what advice means is something quite different to perhaps sometimes how the regulator sees it, but we're certainly not going to resolve that, and certainly not on this webinar today. But what we can tell you is that we do see in general a lot more of an explicit advisory nature and service provided by some of these banks and brokers, to the extent where it's routine to see correspondence where the salespeople at these banks or brokers are saying, we recommend you should look at this. We just put in place a structure for you 2 weeks ago. We think this would be a good idea for you. I think this would be a good way for you to sell your dollars for the next 6 months. Now, that may sound somewhat strange in the context of what some of you may have seen in the interest rate dispute world before, where generally the words advice and recommendation are kind of shied away from, and even if not, people sort of rely on sort of the kind of disclaimers to sort of exclude the liability on these things. But I do think it certainly can make a difference when the words advice and recommendation are being used in language and in form a lot more. But again, it's for the solicitors and the barristers to actually to do something with that. Limitation, I don't think is too much of an issue here. Again, for a couple of different reasons. Interestingly, from our experience, we've seen, I don't think the banks really changed or significantly improved their processes in how they were selling some of these products, right up until the FCA review, which was obviously announced in June 2012. So I think certainly up until then, there'll be potentially some complex, inappropriate products that have been provided to businesses. But when one looks at these foreign exchange brokers, then actually, we've seen complex, inappropriate products provided even as early as, even actually leading up to the Brexit referendum vote, which is this year. So clearly, it's kind of refreshing not to have to deal with the limitation issue to an extent. But again, it also makes a difference on what's unique about currency claims. Is also depends on what's happened to that currency pair, because we've seen some disputes in the past where some clearly inappropriate structures have been provided, but actually because the currency has moved in the client's favor, they haven't actually suffered any loss. So obviously that's has a big bearing on that kind of dispute. That we generally see in our experience quite weak regulatory and sales process documentation. Not that I'm saying it was particularly good for interest rate hedging either, but particularly when we're dealing with some of these brokers. So in the last few years, we see that the kind of compliance documentation they have is just of a much lesser standard. I mean, we saw one case recently where it was for a retail client, and the broker did an initial sort of KYC form, as you're required to do by the FCA, back in sort of 2000, and I think it was 12 or 13. And it's just like a one-page, almost kind of like a tick box exercise, saying, what is the level of your risk tolerance between 0 to 10? And those kind of things are almost meaningless to a customer when they're looking at sort of currency derivatives. And there's like a sliding scale saying, do you want to speculate? Do you want to hedge? Do you want to do this, etc., etc.? But it's almost just like a kind of one-page tick box exercise, but then that's never revisited again, and it's just kind of locked away. And then if you look at what that document said versus what the currency broker or the bank has been selling to the client 2, 3, 4 years on, you almost can't. It's almost just unreconcilable. You think, how can this document be for the same client, given the kind of products that have now been given to them? And in terms of the kind of main, who are the sort of people here who have been selling these kind of products? So it is the usual culprits of the banks. I mean, we don't really obviously have the building societies here, but we have seen disputes and have worked on disputes with Barclays, Lloyds, HSBC, RBS, a couple of other ones as well, like Investec, Standard Chartered, Santander, for example. But it's an area which we've also seen a big growth in an area of the FX brokers. Now, these FX brokers are quite interesting in the sense that a lot of businesses, realized over the years that, look, they were getting overcharged currency from their banks because of some of the things that we talked about earlier. So there was a valid market for these currency brokers to come in and effectively, give cheaper currency to these corporate clients. But then what happened is that as that market became more and more competitive, it became harder and harder for these brokers to make money. Some of them started to offer more complex products and started to offer more derivatives. And from a slightly technical perspective, the fact that MiFID II was about to come in meant that there was a big rush to get some of these brokers regulated by the FCA, even though some of them weren't before. And after they became regulated, even though MiFID II was not happening, some of them took the view that, look, let's just start selling some of these currency options because they can make some more money from it. And it's quite interesting because these currency brokers obviously still have to go to the main UK banks or investment banks to source and actually execute these products. So, the UK banks are still making money from selling these products, although arguably they've removed some of their conduct risk because it's these currency brokers who are selling these. And some of the names of some of the brokers that we've seen, which are particularly big and, well, they're just large brokers, and we have seen some issues with some of these brokers are World First, TT Money Corp, Global Reach Partners, and the Western Union, a couple of these sort of types of brokers who, not saying these brokers are bad, but we're saying that we have seen in some cases some inappropriate structures provided for them, just like we have from all of the UK banks as well. What is interesting, however, is, again, a bit different to the interest rate market, is where we see customers who've entered into multiple relationships with multiple financial institutions. And sadly, this also happens when sometimes these businesses get too full up with one broker or one bank, and then they go along to another bank or another broker and start to buy currency from them. And sometimes these brokers or banks, in my opinion, sometimes turn a bit of a blind eye to thinking, actually, what else is this customer doing? Does he really need to be buying more dollars from me when he's got existing contracts with someone else, etc., etc.? And in the worst case, unfortunately, sometimes we've seen cases where clients have ended up contracted because of inappropriate products to buy or sell too much of one currency, more than they actually have or need, and they then have to go to another broker to start buying the opposite level of currency just to satisfy something they've already entered into with another bank or broker. And it starts to get very complicated, and of course, it's just a bad position for the company as a whole. What we also see in this market, like we touched on earlier, is a real lack of transparency. And even simple things like spot and forward contracts, one may think that, look, there is a lot of transparency there, and we can all go on the internet and have a look at what spot prices are. Spot price just means the current trading price. But actually, there is a bit of a murky world emerging between, looking at, there are only a handful of global investment banks who actually control what the actual intraday pricing really looks like. And I know some of the solicitors, for example, have been looking at sort of FX price manipulation, whereby it's not been, you can feasibly see why it's been easy enough for some of these banks to collude and move some of these things in the past. But again, going back to these derivatives, obviously with currency options, there's just no transparency there at all. Some of these products actually, again, a little bit different to the interest rate market. A lot of these products then end up being more what I call speculative products rather than hedging products. So they are almost kind of just like gambling almost, where you're taking a pure punt on something, because there are, some of these contracts are ones which can be cancelled or knocked in or knocked out, and it's a little bit analogous to sort of the callable swaps that we have seen on the interest rate side of things, whereby these are, how I describe them as heads I win, tails you lose products. whereby if the currency moves in the client's favor, they might think, great, I can now purchase my dollars at a better price. But actually, at that very moment, or within a few days of that moment, actually, the bank or broker is likely to cancel the contract. Whereas vice versa, if the dollar moves against the business and they'd rather be free from this contract, the bank or broker won't cancel it. So you can end up into getting products which are more speculative of nature than on the interest rate side. But again, there is also an important issue here between separating, I think, sometimes client greed versus bank or broker push. On the interest rate side, it's generally, generally speaking, yes, of course, customers wanted as low borrowing rate as possible, but they fundamentally either wanted or were required to have protection against rising interest rates. On the currency markets, yes, importers and exporters do need to protect against their budget rate or their bottom line, as we discussed earlier. But unfortunately, it's an area where everybody seems to have a view and a speculation on where the dollar's going, where the euro's going. Everyone seems to think they know the market and they can play the markets. And sometimes we've seen too many owner-managers, and sometimes even the finance directors, get carried away by trying to make gains via currency movements, but that isn't their business. Their business is to buy and sell widgets or sell holidays or food, not to try and make gains in the currency market. But again, if they want to make that decision, that's completely up to them. But then again, you've got to understand, if you're taking speculative views, there are going to be associated quid pro quos that may not be clear to you, which is why, again, we call it sort of smoke and mirrors. On the one hand, it may look like a very attractive product, which looks like it's got similar risk characteristics to just a simple forward contract. But actually, there are some pretty nasty stings in the tail, which are not easy to come out. I mean, some of these products, some of these products are so complicated, it can take us, as specialists in this field, several hours to be able to price some of these contracts, just because they are very bespoke and financially engineered. And then what we sometimes see is contracts which are too long. Interestingly, like I said earlier, we've been discussing this with the FCA, and one of the things I understand from the FCA is the FCA feels that some of these contracts are not that long, and therefore the loss to businesses isn't that significant. So that may be true, when you're just looking at an isolated contract of 3 or 6 months long. But we've unfortunately seen contracts which have been entered into for 2 or 3 years in some cases. And 2 or 3 years in the currency markets is almost equivalent to sort of 20 or 30 years in the interest rate markets. It's a very, very long time. But it's not even just the short-term contracts, because what often we've seen is these things are then churned. And what can happen is these contracts just get rolled over, restructured ad nauseum. And what you're effectively doing is just digging a bigger and bigger hole for yourself, although that may not be apparent to the business as they're kicking the can down the road. And then the last bit there is just sort of saying some of these are too large. Some of these contracts have got leveraged or ratio elements to them, whereby if a certain barrier or trigger level is hit in the currency markets, they have to purchase or sell twice or 3 times the amount of currency they may do otherwise. Now that in itself comes with its own associated problems. From the simple perspective, the business owner doesn't actually know how much hedging he has, because you could either have a $100,000 obligation or a $300,000 obligation at the end of the month. And that makes it pretty difficult to manage his business. Secondly, often these things are structured so that in order to give a greater upfront benefit to the customer, the ratio or leverage bit kicks in just when the rate is going against the customer. So you sometimes find these contracts structured just when a barrier is hit and the customer is forced to buy at a horrible rate compared to the market. They're having to do so for 3 times the amount that they would have done even if it was going in their favor. And these things are just horribly skewed against the customer, unfortunately, which again they're unlikely to probably understand at the beginning. Just going to show you here a brief example of, sometimes how these banks or brokers try to explain some of these products. I'm not really going to go into the detail, here. But this is kind of typical way that they sort of try and explain these things. And again, we're talking about the small and medium-sized businesses, whether they're retail clients or even professional clients. We think it's very difficult for businesses to be able to understand, how these products actually work in terms of their risk potential in simple pound, shilling, and pence terms, when all these kind of almost slightly abstract payoff diagrams and things are shown to the customer, which makes it sound all kind of quite innocuous and friendly, saying if this happens on expiry, you'll get this. If this happens on expiry, you'll get this. Makes it all sound quite nice and friendly, but you need to understand the numbers about what the implication means, both in terms of credit risk, margin calls, potential breakage costs, almost like when we say with on the interest rate side of things that illustrations should be provided of breakage costs at various different levels of falling interest rates. Again, banks and brokers can easily do this for the FX world. We do it for clients, and we do see some banks and brokers doing this, where they simply say, this is your structure, this is what the closeout cost would look like at a spot rate of 150, 149, 148, etc., right down to a range. So then the customer can see in pound, shilling, and pence terms, what's the implication of me entering into this contract. So just looking now at on the FX side, there's one such business that we worked on sort of last year. It's a company with 40 odd million turnover with various different currencies, which they had some exposure on. What they had done, however, is enter into a number of different very complex contracts. And what was then happening was they then had a pretty significant outstanding amount with the broker, just under sort of £2 million there. And then the customer simply said, look, we're not paying this to you, or A, because we can't, and B, we just don't think we owe you this because we don't think these contracts are valid and you properly explained them to us. So we sort of did as opposed to actually striking a claim against the broker, it was more the broker then did a claim against the individual business. And we and the solicitors and the barristers were helping the business to do an almost defence and counterclaim against the broker. And some of the interesting things that happened on this dispute were, it's exactly this kind of smoke and mirrors approach I was talking about earlier, where on the one hand, some very nice, attractive, simple forward rates were being provided to this customer, which looked better than anything else they could get from any other bank or broker. But then there was a part B, and the part B had some leveraged elements, some extendable elements, and quite complex elements to it, which basically was the sting in the tail. And it wasn't until we kind of, in fact, I remember actually when we showed it to the client, first of all, what that sting in the tail looked like, the jaw just dropped, thinking, how the hell did we enter into so many of these over the last couple of years? So anyway, after the solicitors, the barristers put forward obviously the documentation, the defence and counterclaim, etc., eventually they did reach a settlement, confidential of course, and a settlement was reached, is all I can say. Again, this is another example where the client had several different brokers, and again, sometimes they were dealing with more than one at the same time, which did complicate matters. Another contract here, so another customer here, a customer in the travel industry, a pretty large mid-market company who effectively buys lots of holidays in the Far East and the Middle East. So obviously they have to buy these things in dollars, and as customers here in the UK are paying for them in sterling. And what they'd entered into here was dozens and dozens, in fact, I think hundreds of, from memory, they entered into hundreds of different currency derivative contracts over the course of a few years, to the extent where it was almost like, how can I put it, the broker had found, had almost led the particular customer, the individual, the finance director of the business, down a certain path, and had almost kind of encouraged them to be speculating and gambling on these products as time went on. And you'd often find a product was being provided, and then literally within a week later they'd say, hey, let's just rip that one up and do a brand new one. Well, okay, that's fine, but every single time the broker's doing that, or the bank's doing it, in fact in this case it was banks, not brokers, every time the bank does that, they are basically charging the same amount of profit and credit spread for the entire 2-year period. Now someone has to pay for that. These derivatives, these OTC derivatives, are a zero-sum game. If the bank is making X amount of money on day one, the client is therefore losing that much money. Okay, they're not paying for it in cash, but they're losing it in the value of the contract, which they then have to ultimately deliver on. So again, here, this is one where the client then sort of issued legal proceedings against them. It was against 3 different banks, and interestingly, this actually settled relatively quickly. It was actually helped by some positive currency movements, which did actually wipe out some of the market, which again shows you the dynamic nature of these disputes. With interest rates, of course, you don't really see that because markets aren't particularly going anywhere positive. In fact, obviously with base rate falling and swap rates falling this year, markets in some cases getting worse. But with currency, sometimes if you have a fair wind against you, it can certainly help the settlement proceedings if some of your liability gets reduced. But vice versa, it could also mean that your liability that you're arguing over becomes a much bigger and bigger number, which kind of adds a unique sort of time pressure to these disputes, whereby the customer and the counterparty is sort of worrying about what could this grow to if we carry on this dispute over the next 3, 4, 5 months. And there isn't any simple, easy answer to that, I'm afraid. So what do we typically do when we're looking at one of these disputes? We call this sort of like an FX sort of mis-selling audit, as it were. But similar to what we mentioned earlier, in terms of we'll actually be looking at the correspondence that goes on between these banks and brokers and the key individuals within the business. We'll be looking at how suitable were these products, how appropriate were they, given the customer's business model, which of course the bank or broker should have been aware of. And of course, sometimes that means even assessing what the bank or broker themselves had noted on some of the initial regulatory compliance information. It's quite handy to be able to say to a broker, look, you yourselves said this and this about a customer 2 years ago in your KYC form. Why are you now providing this information 2 years on, when, these products 2 years on, when actually nothing's fundamentally changed in the client's business model? We look at the actual, some of the regulatory information provided in terms of, we'll look at some of the terms of business documents, the product profiles. The product profiles in some of these products tend to be probably more detailed than one is found on the interest rate side of things. But again, very few of them until recently will come with illustrative mark-to-market implications at different currency levels. And of course, we will help the solicitors and the barristers and the clients understand the complexity of the derivatives provided. Again, I know we keep talking about this, but I need to make this very clear. Some of these products are fiendishly complicated to the extent where, we have, like I said, we've got dozens of years of derivative experience between us, and some of these products are so complicated we've never come across these. And we know of large institutions and FTSE 100 businesses who would not enter into products like this, even though they've got obviously large currency exposures. And then we'll obviously then look at our overall view about whether we think there is actually a dispute there against that bank or broker. And then, interestingly, and we've done this again more so than with on the interest rate side, there are times when we will say to the customer, actually, we don't think you have a valid dispute here, because I actually think that you knew what you were doing. You tried to overreach yourself and you were trying to gamble, you made some gains, and it's now gone against you. Now you're sort of putting your hands up and throwing, saying mis-selling. Well, to be blunt, there are plenty of claims management companies out there who will go away and help you, but we we and the credible solicitors and barristers we work with will not be putting our name to helping you with something like that. So it's important to genuinely look at whether there is an understanding here by the client or not. So just looking at sort of in terms of where we are today now, we would typically charge just under sort of about £4,000 to review some of this initial sort of correspondence and look at some of the pricing of these products on an initial sample basis. But because of our sort of webinar today, if there are any actual businesses or clients, or of course if you are solicitors or accountants and you have clients or someone that may be interested, for the first 5 businesses that sort of contact us, and again you can do that via the chat function, or you can just call in or email us with the usual details, we will basically provide that at a very low price of just under £350 plus VAT there. And we're so confident actually that provided you send us the right information and we can look at that, we'll even say, look, if after us having reviewed all your material and then discussing it and talking through with you, you don't think you've had value from what we've said to you, we'll actually give you £50 back just to show you how confident we are in being able to look at these products. So that's effectively what I really wanted to really talk through. Appreciate it also covered a lot of ground there and there's a lot of detail there. But I know some questions have already been coming in, and I can see some have been coming in by email already. So if you have any questions, please type them into the chat box, and then I will sort of look to try and answer as many as we can over the next sort of 20-25 minutes, time permitting. Thank you. Okay, the first question I can see here says, okay, let's have a look what does it say. Okay, has the how badly has the fall in the pound affected businesses that declare profits in sterling? Well, I mean, you only almost need to look at read any newspaper pretty much every day, and you'll talk about and you'll see some of the largest businesses in the country, having issues, both positively and negatively, depending on how they're reporting things. And of course, this makes a difference for dividends too. For example, looking at Shell, for example, people are talking about how the Royal Dutch Shell dividend is at risk, and it may well be linked to the oil price, etc., etc. But of course, they pay their dividends in dollars. So for UK investors, there's an extra nice little kicker there of sort of 20-odd%. But it is affecting businesses. The reality is that even these large, sophisticated institutions in these FTSE 100 companies, they don't tend to hedge typically for more than sort of 6-9 months at a time. So even where some of these contracts have been entered into, some of them will start rolling off, and then we will start to see currency effects of this coming through. And let's also not forget something which a lot of people tend to forget. People keep saying, "Oh, this is brilliant for our exporters, and it's so good, and it's the revival of British manufacturing, etc., etc." But one also needs to remember, and not to make this too political, but one needs to remember that in this country we don't, we've kind of neglected some parts of our manufacturing base for a while. So even when we are exporting high value items and specialist equipment, we still have to ourselves import in some of the raw materials and components for some of these things. So yes, yes, we will be seeing a benefit there from the exporting, but on some of these issues, some of these import costs will be going up as well. And again, don't forget, large businesses can get affected by this too. I mean, just I think a few weeks ago we saw Sports Direct. I think they specifically made a kind of profit warning because of a £15 million loss on a currency derivative that went against them. And I think pretty much the next day, I think the FD was resigned or dismissed. And again, that's a big business. Sports Direct is clearly can't be seen as a typical SME. But this isn't just small businesses affected by this. Okay, we've had another question here saying, which hedging structures are banks and brokers pushing in light of recent exchange rate volatility? It's a good question. We're seeing some of the better brokers and banks. I mean, the banks are obviously being more careful now. We're seeing them provide genuinely relatively simpler structures. Having said that, it also depends on what your starting position is. A lot of businesses aren't just starting from a clean slate where they've got no currency exposures. And if you're in a position where you've already got a pretty significant out-of-the-money currency hedging contract, there aren't any, to be blunt, nice, easy ways of getting out of it. So it may well be that you do need to do something reasonably complex or reasonably long-term or something more structured than you would otherwise like to, because that is the current position that you're in. Unfortunately, we've also seen some brokers try to take advantage of this extra volatility by trying to push giving them green light to sell even more, or at least market at least even more complex currency derivative products than we've ever seen before, because they know that a lot of small and medium-sized businesses are in a desperate position because they may have been wrong-footed by this massive fall in sterling we've seen over the last few months, and they know that where there's desperation, some of the businesses may enter into something which they wouldn't have otherwise. Now, unfortunately, we do think there are some businesses who are going to enter into some of these. We only hear about these because some of our clients literally show us and send us some of the things their brokers are sending to them, and thankfully our clients don't really enter into these. But unfortunately, I think we will see some more of those going forward. Okay, here's a question. Just 1 second. Okay, what strategy? So we had a couple of questions on the Clinton versus Trump issue. Hopefully, yes, no one's asking us to comment on the private email server of Hillary Clinton, which is good. Okay, so what strategy would you have in place pre-election, Tuesday, November, if you're in a business that's buying circa $12 million a year? Look, this may sound like a cop-out answer, but it genuinely isn't. We don't know, like anybody else, which way the elections are going to go. There is going to be a lot of volatility leading up to the election and probably straight afterwards as well. The advice that we would give, particularly in times of great volatility like we may be able to see, is don't overcommit yourself. Don't enter into contracts which are too long or too large. Try to buy yourselves as much flexibility as possible and only commit to, I'd say, the minimum core amount that you need to at this stage without overextending yourselves. And again, the following question that someone else has asked on that is, would you suggest using derivatives or vanilla tools moving forwards? So this is an interesting question. Like we touched on earlier, there is simply no one-size-fits-all answer here. There are some businesses who we do advise to look at derivatives, but the actual choice of product, whether one looks at a derivative and even what kind of derivative one looks at or forwards, is a sort of 2 or 3 steps down the process. The first step, like we described earlier, is sitting down with you, looking at your business, looking at your flows, looking at your budget requirements, looking at how much flexibility you need, Certain industries have got the ability to change their margins and change their prices. Some customers of ours say to us, look, we actually are pretty unique in what we do. We can actually charge our customers higher prices and feed through for currency effects. Perhaps a little bit like Marmite. Price of Marmite goes up, people are still buying it. So people, can sometimes move prices on. But of course, there are other industries where they are hammed in and they simply cannot change their prices, and one needs to look at it a bit more carefully there. So the answer is there is no simple answer there, but we absolutely, would advocate using simple derivative options, again, for relatively short periods of time, and for relatively small amounts of your exposure, so you have a balanced portfolio. Perhaps some on spot contracts, some on forward contracts, and then perhaps some on derivative contracts. But again, seek advice before doing that. Not necessarily from us, but from whoever you want to seek independent advice from. Don't just please read or take what your bank or broker is suggesting you should do, because they are the ones who are providing you the contract and the product, and they therefore cannot be giving you independent advice on it. Okay, any more questions? I've seen one come in here. How can businesses secure the best rates when their existing hedges roll over? So again, that's an interesting question, which I touched on earlier, where if you're in a position where you've already got a heavily out of the money position, what do you do about that? Again, I'd say seek advice, and pretty damn quickly, because firstly, the kind of product which you roll over into could either improve or exacerbate your situation, particularly if the broker is ripping out more money from it. There was a case where we were just looking at some analysis just recently whereby a broker was trying to help a customer out of a hole, as it were, by saying, hey, look, you're in a pretty nasty position, let us restructure this and this and this. We analysed it, and actually the amount of profit the broker was charging on that transaction was bigger than some of the profits they charged on probably any of the earlier transactions. And this really, really, to be blunt, makes me angry, because you have the veneer of banks or brokers trying to help you, but actually they're just gouging out even more profits from these things. So our advice on that would be seek some advice on that, because even though there may not be many other product options you can go into, by checking the pricing of this independently, you're at least not adding to the problem and digging yourself into a further big hole. Okay, seeing another question here saying, have you seen many inquiries from businesses that are having problems with their supplier agreements? I understand some businesses are asking their suppliers to quote everything in pounds, even if the underlying currency is based in different underlying currency. They loosely agree on a set exchange rate for a fixed period, but now suppliers are looking at jacking up prices. Are these agreements watertight? I guess the best people to ask for that will be Unilever and Tesco. I wouldn't necessarily trust some of Tesco's accounting standards with some of the stuff that's gone on recently. But again, it's quite a complicated area. In fact, I heard I can't remember who it was, the lady who's in charge of the British Retail Consortium this morning, talking about how it does depend on the individual supplier agreements that you have. We are seeing clients raise some more queries jointly with their suppliers and trying to have more frank conversations with them, saying, look, it may have worked for us in the past just to review this once a year on a relatively loose basis, but now things are, we can't absorb this kind of cost anymore. Can we look at doing things on a different basis? One of the things that we have done with clients is, sort of say to them, some clients say to us, oh, we just pay all of our suppliers in sterling, makes it nice and easy for us, and they take all the currency risk. But again, we try to get behind that and say, well, look, if you're paying your supplier in sterling and they're based in Italy or wherever it may be, they're obviously taking that currency risk for you. But they're not just going to do that in a risk-free or cost-free manner. They're going to charge you for it. You are effectively getting charged for it through higher sterling purchases. So we're actually saying to some customers, actually say to some of your suppliers, can we actually pay you in a different or alternative local currency? And then what we then find is that as long as you can, and again we can help them through that, mitigate the cost of actually buying and selling in that currency, you actually find you can sometimes negotiate better discounts when doing that. So your overall purchasing costs become lower, even though you are actually transacting in a different currency. But it can be a very complicated area, particularly when you've got some of the shipping issues and the freight forwarding issues as well. But again, all I can say, as ever, is do seek some independent advice on that. Any more questions? Got someone else asking about, do I think Trump or Clinton? I have no idea on that whatsoever, and again, we'd simply say, look, depending on whatever happens, there's likely to be a period of a lot of volatility. In general, we think there's still going to be a lot of currency and indeed market volatility, even for the UK, and particularly as we figure out what this Brexit's going to look like. But the bottom line is, nobody knows. We are in uncharted territory, and if there's one thing markets hate, it's uncertainty and uncharted territory. But that is the course that we're on, and we just have to navigate that as best we can. Someone else has said, how much volatility do you suggest there can be pre and post the elections? A lot. It's a simple answer to that. I mean, it's difficult to measure that. I mean, there are technical answers to this in terms of looking at different volatility, and in different parts of different currency structures, you are effectively buying or selling currency volatility, and there are hedge funds who do nothing other than do this and try to arbitrage when the volatility of protecting against certain, whether it's a US dollar put or a call option, is high or low at a certain point. But I don't want to get into too much technical detail on that right now. But again, if you do want to discuss that and you want to express a view of looking at volatility of certain currency pairs, then again, we can help you with some of the technical analysis on that. Any further questions at all? Okay. Okay, well, look, if there's no further questions, I know obviously everyone's very busy, so we'll wrap things up there. Again, just to remind you that in fact, we've already had 2 businesses come forward already. So there are, oh God, it sounds like a very QVC presentation, but there are 3 sort of discounted sort of reviews left if anybody wants to take advantage of that. Again, just get in contact via the chat or email or phone, and we will have a look at your currency products and correspondence. Okay. Well, look, thank you very much all for listening, and look forward to speaking with you all in the future regarding your currency or hedging related requirements. Okay. Thank you, everyone. Have a good day.